What's up guys, welcome back to another video. Recently I dropped an analysis regarding the old form of energy by covering the Exxon Mobil stock. Since a lot of you guys however started asking me about the oil industry in general, we today are going to expand on the recent video by covering Chevron, the overlooked brother of Exxon. Before we get to the introduction, I however have to say that I'm not a financial advisor and you should not base your investment on my video. Please always do your own research. Chevron is an energy company that is headquartered in San Ramon in the US. They focus on integrated energy, chemical and petroleum operations worldwide. But more on that in the breakdown of their revenue. For now, let's have a look at the numbers. Right from the bat, we can see that Chevron's valuation is fairly similar to that of Exxon. This however does not come out of thin air and can somewhat be attributed to the revenue of the last fiscal year, which sat at 139.9 billion. But let's break that revenue down a little bit further. Generally speaking, Chevron divides their revenue in three key segments. The biggest one of these is the downstream segment, which contributes about 107.9 billion to the overall revenue. This is then followed by the upstream segment, which contributes 31.7 billion to the overall revenue. And last but not least, there are still the other income sources, which contribute 246 million in revenue. If you are now wondering what upstream and downstream are, I would refer you to the Exxon Mobil video, which I will link on the screen. But enough with the introduction, which we now have knocked out of the way. Let's move on to something which you probably all want to know about, which are the distributions to shareholders. Chevron currently returns capital to shareholders through a dividend and share buybacks. Last of which, however, just became more frequent in recent years though. However, at first let's focus on the dividend, which currently sits at about $5.16, equaling a current yield of 7.25%. But while we've now somewhat talked about the current distributions, let's also have a look at the past distribution history, as this can indicate how focused on the dividend a company actually is. For the case of Chevron, we are able to recreate the dividend until the year of 1990. However, it sadly has only been constantly increased for right about 4 years, at an average 5-year growth rate of 2.6%. This makes Chevron a somewhat slower grower, but it adds some more dividend safety if you ask me. When it now comes to stock buybacks, these are harder to track. However, it can be said that these are somewhat less consistent, with shares being issued from 2015 to 2017. But in order to figure out how much Chevron actually distributes to their shareholders and how sustainable the distributions are, let's put the total distributions into contrast with the free cash flow. Right from the bat, we see that there is no free cash flow in 2015 and 2016, as in these years the free cash flow is negative. This overall isn't a great thing, as not being able to cover your distributions with your free cash flow means taking on debt in the long term. This was however fixed with tighter budgeting and an increasing demand in the industry. For the year starting in 2017, there's pretty much nothing major to argue with, as the free cash flow generally covers the distributions. But let's also have a look at the balance sheet in order to evaluate the overall financial position of Chevron even further. As per usual, let's start out with the year of 2015, in which Chevron's total assets sat at about $264.5 billion. These were made up by about 34.4 billion in equity, 33.6 billion in long-term debt, 4.9 billion in current debt, and 191.5 billion in non-interest paying capital. But in order to be able to actually evaluate this even further later on, we want to calculate the net debt. This is obviously done using Chevron's debt and its cash position. For the year of 2015, this sits at about 27.2 billion US dollars. But let's set that value to the side for now and get back to it in just a second, after we have taken a look at the balance sheet of 2019. As you are able to see, Chevron's total assets decreased over our time frame to about 237.4 billion US dollars. These were made up by about 28.3 billion in equity, 23.6 billion in long-term debt, 3.2 billion in current debt, and 182.1 billion in non-interest paying capital. But now let's calculate the net debt like we did for the year of 2015. This time, however, we get a net debt of 21.2 billion, which is a decent decrease. But let's also find out how sustainable the debt which we just calculated actually is, and whether the debt has gotten more or less sustainable. This is done using the EBITDA, which is the pre-tax, pre-interest, pre-depreciation, pre-amortization income of said company. After doing our basic calculations, we are left with a sustainability of 1.5 for the year of 2015 and 0.59 for the year of 2019. This means that over our time frame, the debt has gotten more sustainable. Alright, since we now have the financials covered, what we want to do is get the margin of safety, which will help us with determining our buy price later on. First of all, I have to say that Chevron, in my opinion, is somewhat the overlooked brother of Exxon. While they are somewhat less popular, they have actually managed to outperform their peer group over the past years. This makes them fairly attractive to dividend investors, especially with their, in my opinion, fairly safe dividend, even in the current times. For this reason, I'm going to reduce my safety margin by about 5%. When it now comes to more upsides of the business, these are also somewhat linked to those of Exxon. And that is that big oil isn't going to disappear in a few days. Chevron and a ton of other oil companies are and will still be required to fuel the economy and the shift to renewables. What however makes Chevron, in my opinion, the more favorable company regarding this fact is that they are actually selling off assets to free up capital to invest in renewable projects like technologies or more green solutions for their current services. For this reason, I think Chevron will have a bigger impact in the future and will go hand in hand with renewables at some point. For this reason, I'm going to reduce my margin of safety by about 20%. However, I have to say that Chevron also has some downsides. At first, one has to still admit that while Chevron invests in the future, they are still an oil company. Thereby, it's only logical that they are also being affected by historically low levels of demand as well as low oil prices. For this reason, I also expect a short-term hit for Chevron, which is the reason that I will add 5% to my margin of safety. Last but not least, I still have one, in my opinion, downside to Chevron, which however is pretty much complaining at a fairly high level, and that is their balance sheet. While their balance sheet is decent, it does not give them nowhere near the competitive advantage which, for example, Exxon has with theirs. But at the end of the day, I still have to say that it somewhat depends on how you use your assets. Therefore, I'm going to reduce my margin of safety by a small amount of 5%. In order to get the fair value of the stock, we have to take a little look at the historic dividend yield. For the past 10 years, we had an average dividend yield of 3.6%. This obviously means that you want to buy the stock if the yield is above that average. This would mean with the current dividend of $5.16, a fair price to pay would be $143.33. Note, this however is only in respect to the dividend. If we now want to calculate the value I would pay for the stock, all we have to do is again get the average dividend yield of 3.6% and my safety margin of 10%. This gives us our target yield of 3.96%, which leaves us with a price to buy the company at of $130.30. However, a more reasonable fair price to buy the company at with its future outlook for me, however, would be at right about $95.75 with a personal buy price of $82.30. Overall, I would currently rate Chevron an absolute buy for those following a value investment strategy with an outlook on the next 10 to 12 years.